Is it possible to have too much of a good thing when it comes to Roth conversions? Well, here to talk with me about this is Dana Anspach from Sensible Money. Dana, welcome.
Thanks, Bob. Great to be here.
Great to have you here. It's a curious question. Is it possible to have too much of a good thing?
Well, I think it is. I call Roth IRAs one of the two superhero retirement accounts. So Roth IRAs and health savings accounts are one of the few ways you can truly grow money tax-free. I love them. I'm big fans. I'm big fans of Roth conversions. But lately we've got some inquiries from people who want to convert everything to a Roth, or they're already in a really high tax rate. They have a lot of tax deferred assets and they've read about Roth conversions and they are almost taking it to an extreme. And so, yeah, I actually think there can be too much of a good thing. And so you have to be careful not just to assume that because they're so fabulous, you should put all your money in them.
Right. So you have a methodical way of going about it in terms of measuring the success, right? When you're looking at whether to do it or not.
We do. And that came about because there's so many simplistic rules out there. So you will see people who just say, well, if your marginal tax rate is about the same or lower in retirement, then don't do Roth conversions. And if your tax rate's expected to be higher in retirement, then do Roth conversions. That's a very simplistic rule. I've also seen these proponents of, the goal of getting to zero tax, which would mean, how do I convert all of my tax deferred assets to Roth IRAs now so that later in retirement, I pay zero tax? One client question I recently got from a client, I'd never heard this before, was they had read that you should convert enough to a Roth IRA that by the time you get to the age where your required minimum distributions begin, which is age 72, that your required minimum distribution would be about equal to your standard deduction. And so essentially what would happen is the income from your IRA would be offset by the standard deduction. So the standard deduction right now is $25,100 for a single person, but you get an extra $1,700 once you're over 65. So if married, your spouse gets that too. And then you have to inflate that. That factor is adjusted for inflation. So if we were to fast forward to someone 10 years from now, maybe they would have a $36,000 or $38,000 standard deduction. Well, that's complex planning, right? You'd have to project out your IRA balance and what's my RMD going to be depending on the growth rate, and how do I get that to, quote, have zero tax. And so I don't know that zero tax makes sense. Me, I'm a math person. I have to do the math. And what if you had to pay so much taxes up front that, yeah, you have zero tax after this point, but you can't ever recoup that cost? And I think that is one of the factors that maybe people are missing when they have this goal of getting to zero tax.
So there's a better way?
Well, I always think there's a better way than simplistic rules. I think, rules of thumb are great. They get you thinking, they get you sort of contemplating about the relevant factors. But yes, there's a better way than simply looking at marginal tax rates. And it has to do with all of the other components that retirement income, that fit into your tax return when you're in this retirement income phase. So one of them is capital gains tax, and that impacts you at any age. So if you have more income today because of a Roth conversion, you're going to have less income later because you're going to have, when I say less income, I mean less taxable income showing up on your tax return. You're going to have less taxable income later because you'll have lower required minimum distributions. Well, anytime you put more taxable income on your tax return, that impacts the rate at which any capital gains are taxed. So that is a factor at any age. You have the healthcare premium tax credit. So if you are retiring pre-65 and you're trying to keep your income underneath the threshold to qualify for a credit, if you were to do Roth conversions, that could mean you don't qualify for that credit. And we have people where that credit amounts to $20,000 to $30,000 a year of premium subsidies. It's not a small number. Yeah. You have Medicare Part B premiums. So if you're contemplating Roth conversions between, let's say, the age of 63, because it's your tax return 2 years prior to your Medicare Part B premiums, that impacts the level of your premium. So if you were contemplating Roth conversions between 63 and 72, you have to factor in that. And of course, if you do Roth conversions and it makes your RMD lower later, then it could potentially lower your Part B premiums later in life. And so it's this balancing act. And then you have Social Security taxation. And so if you are contemplating Roth conversions after the age at which you have begun Social Security, it's also going to impact that. For lower income households, that's a little bit more of a factor. If, for example, your taxable income is about 90,000 or less, it could impact your Social Security taxation. Once you get into higher income amounts, likely 85% of your Social Security is going to be taxed no matter what. So all of those factors come into play when you are contemplating a Roth conversion. And the very simplistic rules of look at tax rate now and tax rate later don't incorporate all of those factors. The very simplistic online calculators don't incorporate all of those factors. So it's not an easy answer. It's not a plug and play rule of thumb. You need a model where you can plug in the Roth conversion and actually see the impact on all of these factors and decide, does this improve your bottom line? Does this actually add value to your financial situation? And that's a challenging question to answer. If it was easy, we would all know what to do.
So you've come up with a way to measure whether or not to do this.
Well, I've come up with a few ways. I don't know that I have the monopoly on this, but I definitely have spent a lot of time trying to think about how do I come up with an answer that makes sense. And so one of the ways is something we call liquidation value. So if I liquidate an IRA, or if my heirs inherit a tax deferred 401k or IRA, they have to pay taxes on it. And if they inherit a Roth, it's tax free. If they inherit a brokerage account with mutual funds and stocks and bonds, they get a step up in cost basis. It's essentially tax free. We're not talking about estate taxes, just income taxes here. And so one way that we measure the success of a conversion strategy is, did it increase the after-tax liquidation value at the end of plan? The challenge is, if I'm working with someone that's 55 or 60 today, the end of plan can be 30 or 35 years in the future. And that might be great that they're leaving more wealth at the end of the plan, but that isn't always the goal. So another way we measure it is we look at what is the amount of withdrawals that someone has to take over their lifetime, including what they have to withdraw to pay tax. And if I do more Roth conversions now, they're going to pay more tax early, but maybe less later. But I can still calculate over their lifetime, what is that number? And so if I implement a strategy like Roth conversions, and over their lifetime, it actually lowers the total amount of withdrawals that they would need to pay taxes, well, again, that is an improvement in real cash flow to their financial plan. But again, it doesn't tell me how much time it takes. And so that brings me to the third factor, which would be break even. So I recently did an analysis for a retired CPA, and she just doesn't like the idea of paying a big tax bill right now, even though we think Roth conversions could add a lot of value to her situation. So we looked at a larger amount of Roth conversions. It was about $210,000 a year of Roth conversions from now through 2025. And it was about a 12-year break-even analysis for her. And I can't remember her exact age. I believe she's around 67. And so for her, that seemed like a long ways out. She'll be nearly 80 before that Roth conversion on paper makes sense. And so then we modeled a smaller version of Roth conversions, about 50,000 a year. And that break-even point actually happened in 5 years on an after-tax basis. And she really liked that. That felt like a number that it made sense to her, that if she were to pass early, the Roth conversions didn't hurt her overall wealth in any way. So I think that's a factor too. All of those factors can come into play, and we often frame things in terms of red, yellow, or green. A red would be like, no, this amount of Roth conversion or whatever the strategy is doesn't make sense. A green is, yes, this clearly adds value when we look at the numbers. And so many of those decisions fall into the yellow, where you have to have conversations around these nuances and what really makes sense.
Right. So a lot of folks have much of their money perhaps tied up in 401k, IRA accounts. And there's always quite a bit of discussion around the need to have account diversification or tax diversification. Any thoughts about that?
Yeah, that is one of those yellow factors. So if we are looking at implementing a Roth conversion and it's in what we call the yellow, meaning this Roth conversion is likely to add value to your household if, and then there's a series of things we look at. And one of them is if it adds tax diversification and you need a lump sum in 10 or 15 years to buy a car or fund an expense for an adult child, great. Now you have a bucket to pull from that isn't going to impact your tax return. That's a positive. Another one of those factors that could sway a yellow decision to green is, are you never going to spend your wealth? Is your goal really to pass along maximum wealth to heirs? Well, great. Then the Roth conversions, if you live long enough, are likely to add value. Another factor is longevity, right? Someone's health. How long are they likely to live? Another factor is if they're married, is one of them potentially going to be filing as a single person for 5 or 10 years later in life? The Roth conversion provides that sole survivor a tax-free bucket to draw from at a point in time where they will be in a higher tax rate. And then the other is what we call asset location. So is there ability to take the investments with the potential for the highest return and put those into the Roth bucket, and that could add even more value to the Roth conversion. So tax diversity, as you were asking about, is one of several factors that we look at, that we have discussions with a client to say, these are some other reasons that could make this look even better than how it looks on paper.
Right. So Dana, I know you're filled with client stories about these things. Any to share there?
Yeah, I did another Roth conversion analysis actually just this morning before we were recording. And this is a single woman who is looking at implementing a series of Roth conversions. And so we looked at doing 100,000 a year, 125,000 a year, 150,000 a year, and 175,000 a year over the next 4 to 5 years. So why the next 4 to 5 years? Well, under current tax law, the tax rates are set to revert in 2026 back to what they were in 2016. And so if nothing else changes and the tax rates revert, our income stays the same, we will be paying at a higher tax rate. And actually the standard deduction is set to go back down in that year also. So that could impact that type of strategy. So for us, that means if I were going to front load my Roth conversions, I might want to do it in these next 4 to 5 years before those tax rates potentially revert. So that's what we were looking at. And she's also 66. And so by the time she starts 72, she'll have a pension actually that starts at 70 and then required minimum distributions and Social Security. So she has less taxable income right now. Well, ultimately in her situation, once we got to $175,000 of Roth conversions, that last $25,000 jump, so we looked at $150,000 conversion and then 175. That last $25,000 jump would be taxed at an effective rate of 31% for her. Whereas the other Roth conversions would be taxed at a rate that was lower, essentially most of them at 24% and possibly some at an even lower rate. And so doing that little bit of extra, when we looked at the numbers, didn't make sense. She's never projected to be in a tax rate higher than 28% later. So I don't know if in her case, just on paper, none of the numbers added up to do the extra amount of Roth conversion. And that is where, yes, there can be too much of a good thing. People can get so excited about tax-free growth, but they may miss the big picture.
All right. So as you know, I'm prone to throwing curveballs at you now and then. And so the last curveball today is how a backdoor or a mega backdoor Roth conversion sort of equates into our discussion.
Yeah, well, I think the mega backdoor Roth that almost got taken away from us, but now it is still available, is primarily available to people who are still working. And so you have to have earned income to fund a non-deductible IRA or to fund your after-tax contributions to a 401k that you can then convert to the Roth IRA within your plan. And so I think those strategies are fabulous, right? While you're still working, it's allowing you to get money into that tax-free bucket. I'm a big fan of those. And they are separate than Roth conversions, and the type of Roth conversions that we are often focusing on are, after someone is no longer working, then what are the opportunities available to them? But as I said at the beginning, I'm a fan of Roth conversions. And so with the backdoor and mega backdoor Roths, if there's an opportunity to get money in a tax-free bucket, most of the time the answer is do it.
All right. Dana, as always, pleasure chatting with you, having you share your knowledge and wisdom with our viewers. Can't wait to record our next video.
Thanks, Bob.